If you started investing on January 1st of the year 2000, how much money do you think you would have? In terms of percentages, you would be up 174%. And so the question is, do you think that's good? And do you think that would get you to be a millionaire? If you were investing, let's say in ETFs or index funds, do you think that was gonna be enough to get you to where you need to be? And so that's what we're gonna talk about in this video. What do you need to actually do to get something like this to turn you into having $1 million inside of your ETFs or your index funds? Okay, so before we begin, hey, my name's Robbie. I make videos on ETFs, index funds, general personal finance, stock market commentary, tons of stuff about investing. So thank you for watching my videos, and let's figure out how to get to $1 million in ETFs or index funds. The first thing we want to do is we're going to start with $1,000, okay? So this is the idea of how do we figure out how to back up the math to get to where we want to get in this situation. So we're going to say you have $1,000 to start. So everyone probably watching this can get to this point, right? You can get to this amount of money, $1,000. The next part's kind of hard for a lot of people. So the next thing is you're going to need to invest $500 per month. Now, this actually might be a bit difficult for you. It may not. It depends on your financial situation, of course. So let's say that you were able to start investing in the year 2000, which I just showed you. And let's say that you make $50,000 a year in income. Now, back then, $50,000 a year is more than it is today, obviously, right? So what we want to do is kind of just so you understand how much that is in today's dollars. That's $86,181. So if you made that today, $86,000, let's say, well, it's like the equivalent of making $50,000, okay? So just to put it into context for you. Next up, we have the percent of income invested. So how much of your paycheck ends up going in if you're investing $500 per month, and that ends up being $6,000 per year, well, it ends up being 12% of your $50,000 income. Okay, so the next thing we need to do is we're gonna say, okay, we're looking at this over about a 22-year period, right? Just over 22 years. So if you started today, or you start back into the year 2000, you go 22 years ahead, you're in 2022, you're in where we are now. Now, if we're gonna go ahead another 22 years, we're saying, okay, 2042 is the time that you could get up to $1 million in this situation. Now, to get to this portfolio of $1 million, we're gonna test how much $500 a month going into the S&P 500 tracking ETF. It's called SPY, SPY. That's a ticker symbol. And we're going to talk about specific ETFs in this video so you can kind of find some ETFs that might help you if you're trying to get to this point. So we're going to talk about SPY today. Now, I'm using SPY because SPY goes back pretty far. And I'm actually going to what's called back test a portfolio. I'm going to look back at an actual portfolio of owning this ETF and how much you would have made if you own this specific ETF. So this is what ends up happening. Remember, we're putting $500 every single month into this ETF, and we start with $1,000. So if this happens back in the year 2000, you have $568,000. So what happens is you don't end up quite getting there. This ends up being a money-weighted return, which takes into consideration the cash flows, because we're putting money in every month, of 9.53%. So that's a very good return, right? Over almost 10% return is a great return, I would say. And then in terms of how much you would have lost in a specific year, so you understand some of the risks that this ends up entailing, is that the most you would have ended up having down would have actually been 50%. So you did have a time period where you lost 50% of the value of your money. And that's an important part of what we're going to talk about today, because risk is a real thing. These are the actual annual returns. So in a specific year, how much did you make? And so for example, the first year, you were actually down 9.73%. And then you were down again, and then you were down again. So you had 3 really bad years at the start of the year 2000. And then the question is, will that affect you? You know, can you withstand that? Because if you take the long view like we're doing in this video, you need to be able to. You need to be able to say, okay, I'm going to invest this money. I don't care what happens over a very long term period of time, 22 years, and I'm just going to keep going. That's what you got to do when you do this, okay? Because you're going to have years like this. When 2003, you're up 28%, but then you're going to have another year like this where you're down 36% in a year. I mean, a very bad year to be investing in 2008. And then you have all these other pretty good years, and then we have today, right now, it's not a great year right now. Now, to get to $1 million, we got to make a bit of a change, right? Because the $500 a month, it's just not quite getting us there. So let's figure this out. So the salary, again, in the year 2000 was $50,000 a year. In today's dollars, that's $86,000 a year. the percent of income here invested was 12%, and we went over that. That was $500 per month, $6,000 a year. Okay, we need to up that basically. And so what we're going to do is we're going to say, okay, we're going to go from 12% of our income up to 21.6% of our income. Remember, if we want to do this in 22 years, this is what we're going to kind of try to figure out. You could, of course, do it over 30 years and maybe invest less money, but I'm trying to get us there a little faster, right? I'm trying to get us there in 22 years. So in 22 years, what if we put $900 a month, which would have been $10,800 per year, right? That's how much money you would be investing per year. And you'd have to essentially invest 21% of your income every year. So here we can see the results investing in the S&P 500 ETF SPY, and it ends up growing with the same amount of money, $1,000 initially, but $900 a month instead of $500, it grows to $1.02 million. So you get there in 22 years. You get to this amount of money by saving about 21% of your income if you made $50,000 a year. All right, now let's be a little creative, people. We're gonna be a little creative. Let's change this around because, okay, let's say we can't quite invest $900 a month because that's out of our budget. So what do we gotta do? Well, we gotta maybe insert time into it, or we could do another thing that we're gonna talk about after this. But okay, let's talk about inserting some time. So we're gonna go with 28 years instead of 22 years. You're just gonna have to just work a little longer, do your thing a little longer, unfortunately, but that may get you there. So let's see what happens. So if we take a look, $1,000 a month first invested, growing at $500 every single month over 28 years instead of 22. Now you have $996,000. So you got about $1 million, right? So there you go. You just have to work a bit longer and do this a bit longer. So you have to go from 22 to 28 years. Another thing we need to talk about, because a lot of people think that this is a different way to do this, is, okay, I need to just take more risk and increase my return. So here's a way that some people do it. They say, okay, I'm not going to invest in the SPY ETF, SPY. I'm going to invest in an ETF that I think might grow a bit more and probably is going to have more risk, right? And so what we do is, okay, we say, okay, which of these ETFs might be a good one? Well, let's look at QQQ. So QQQ, or QQQ, the ticker symbol, invests in the NASDAQ 100. So it's going to have more tech kind of heavy portfolio. And so it's a bit different of a setup than the SPY ETF. The companies that are inside that you're going to be investing in are a bit different. And what happens with, if you look back to investing in QQQ over a 22-year period, and in this one, we're doing the $900 per month again. So again, remember, $1,000 initial investment at $900 per month grew to $1.02 million for SPY. Well, if you go with QQQ, the NASDAQ 100 ETF, it actually grew to $1.58 million. So what happened is you took more risk, but you got more return. Now, in terms of more risk, how much more risk did you take? Here's the kind of huge issue. You had a year, you had a max drawdown. There's a point where you got up to a certain level of your money and you lost. Your value went down 81%. You have to think to yourself, can you withstand that? Because most people can't. Most people will pull their money out if they lose 81%. Now, if you didn't pull your money out and you kept it going, grew to $1.5 million, obviously it was good and you're rewarded for not taking your money out. But most people, psychologically speaking, they can't get through that. And even 50% is a huge psychological burden for a lot of people. So when you do something like this, when you decide that I'm going to go ahead and I'm going to do this, I'm going to put money into these ETFs, index funds over a long-term period of time, you have to commit to it. There's going to be times where you're going to be down huge amounts of money, but you just have to keep investing and know that over in the past, it's been a great way and you've been rewarded for doing things like this. Now, before I mention some specific ETFs to maybe get you to this, let's talk about another strategy. What if you don't just invest in one ETF? Like, what if you invested in both of these ETFs together? So if you did that, SPY and QQQ, well, what if you put 75% of your money into SPY? What if you put QQQ 25% of your money? What's that look like? So again, going back to the $900 per month, so adding in $900 every month, what's that look like? Well, if you did that 75%, 25% split, it's $1.149 million. So you get more money. And so technically, you could probably put a little bit less money in this portfolio to get to the million. And so here we go. We can see if you invest $800 instead of $900, you're going to get just over $1 million investing in the portfolio with 25%, 75%. Now, the other part of this though, you had a return of 10.46%. You can't necessarily expect this to happen going forward. We don't know if you're going to get a 10.5% return in these types of ETFs going forward, or if it's going to be a 6% return going forward. We don't know that because it's impossible to know what happens in the future. What we do know is over the long term, there have been decent gains in stocks. And by investing in the stock market through something like SPY, you were able to compound your money at a decent amount of return. So whether or not you're going to actually achieve this, you will have to see over a long-term period of time. But remember, this did work out if you ended up investing $800 per month, 75%, 25%. Okay, let's talk about some ETFs. Now, I'm assuming a lot of you are beginners, so we're just going to talk about some easy, simple ETFs, nothing complicated here. So I already talked about SPY, SPY. This tracks the S&P 500. What's the S&P 500? It's the largest 500 stocks inside the stock market, okay? What is that? So Apple is the largest stock. So the largest holding in SPY is actually Apple. You're going to have Google, you're going to have Amazon, you're going to have Microsoft. You have all of these companies that you know of that are huge companies, along with not, of course, just those companies that I mentioned that are more tech kind of companies. You're going to have Home Depot. You're going to have all sorts of different companies in this ETF of good giant companies that you've heard of. Now, the thing with SPY is that it's a little bit more expensive from an expense ratio perspective than VOO. So my thought is always go with a cheaper expense ratio to get the same thing. So you could get about the same thing if you're just doing this and passively investing it, just putting money into it every single month. Well, there you go. You could go with this ETF. Well, what if you want to go with QQQ? Okay, QQQ, the NASDAQ 100 ETF we talked about before. But what if we want to get a bit cheaper QQQ? Well, you can go with QQQM. QQQM does the same thing as QQQ. It's just a bit cheaper. Finally, if you want to go with just a total stock market ETF, you could do that. VTI, this is another Vanguard ETF. So this is Vanguard, VTI's Vanguard, VOO's Vanguard. And so if you do that, you're going to actually get every single stock that's basically trading in the stock market. So it's going to have a few thousand stocks in this portfolio. So you're going to average all of these different stocks, highly, highly diversified. And some people love the total stock market ETF. Now, some of you watching at home, you might not want ETFs. You might want index funds. They're basically the same thing, right? They basically have a pool of different companies in them that track something. And so we're going to look at one that tracks the S&P 500, VFIAX, a Vanguard index fund. This does exactly what the VOO ETF does. It's the same thing. Or we can go with VTSAX, VTSAX they might call it. So tracks the total stock market like VTI, the one I just showed you before, does. So these are like the equivalent index funds you can get for those ETFs that I mentioned, right? So if you want to go with an index fund, you can do that, or you can go with an ETF if you want to. I hope this video ends up helping you on the path, on the journey to potentially get your money to at least $1 million inside an ETF or an index fund, and hopefully you can do it within 22 years, maybe even less. So get out there, try to start investing, try to start doing this, do your best, and hopefully you'll hit that like button and subscribe if you do end up doing that. So do that, please. Actually, do that before you leave this video. And I have a disclaimer here, and we'll see you next time.